Good afternoon. This is Jack Martin with InsureMark. Thank you all for joining us for our lunch hour, Responsive Solutions to Changing Retirement Needs. I want to thank you for carving time out of your busy schedule to join us. We're going to try and knock this out in the next 30 to 35 minutes, and we've got a pretty full program. So we're going to go ahead and dive in. We are recording this today, and so tomorrow you'll get an email, and it's going to have a link that'll take you to a replay of this webinar. We also encourage you to ask questions. There's a Q&A box in the GoToWebinar toolbar on the side of your screen. And if you've got audio issues and you're dialed in on a computer, then you may want to turn off the speakers and dial in on the phone. That typically clears up most of those kinds of problems. I'm going to make just a couple of quick comments about the overarching subject that we started this with, which is the changing needs of retirement and how that's being revisioned. And then Ted is going to dive in and give us a very complete and enlightening look at what some of the new solutions are to these problems. So if you're not familiar with AgeWave, that's Ken and Maddie Dykewald's company. They obviously are the preeminent research house in the United States, maybe on the planet, when it comes to the subject of longevity and what's happening with retirement and how it's changing. And I think if you look here on the screen, what you can see is what a traditional linear life plan has looked like in the past, you know, where we go to school for a while, then we graduate and we get a job and we have a family, and then we kind of kick back in the rocking chair on the porch. And really what's happened over the last 20 years is that longevity is exploding. The advances that are happening in medical science, what we're understanding it takes in order to stay healthy and create a healthy lifestyle and extend that life is really changed the game. And so a lot of folks think of the longevity bonus, if you will, as something that you tack on to the end of your lifespan, when in reality what AgeWave has discovered is that's definitely not the case. But rather, folks are extending different stages of their life by adding that bonus. And so what you see is a little bit more cyclic life plan as opposed to one that is more linear. Now, what that means to us is that there are different stages that we're going to go through in life. And in those different stages, we're going to have different emotional and as well as financial needs. And when it comes to those financial needs, one product may or may not be the solution for that all of those stages of life. But there are ways that you can manage your funds in a flexible environment, in more responsive solutions that may allow you to bridge many of those stages of retirement. And so what AgeWave has uncovered is this concept of flex retirement, where people cycle between work and between leisure. Less than 30% of folks today say they're never going to work again. That means that 70% are either going to continue to work full-time, part-time, or cycle back and forth. And so this concept of flexible retirement is something that you can start to educate your clients about to help them embrace as they go through this cyclic retirement period that is so new for all of us. And so boomers are revisioning what retirement looks like. We're reshaping it, and a good label to put on that is what's called flex retirement. And I think that's a good setup for us to think about how Ted and his solutions may be of help to us. And so, Ted, what I'd like to do is pass the baton over to you and let you now dive into some of the solutions that can address these many stages of retirement. So, Ted, take it away.
Thank you, Jack. Appreciate it, and appreciate everyone taking the time to join us today. My name is Ted Johnson with Market Synergy Group, and for those that aren't aware, at Market Synergy Group, we are a product development company. We build products, primarily fixed annuities and fixed index annuity products, and then partner with some of the top carriers in the marketplace to deliver those through an exclusive subset of distributor partners, of IMOs. And InsureMark is a founding member and one of our top partners. And so again, we greatly appreciate the opportunity to be spending a few moments with you today. What I want to talk about is how we position products, and more specifically, today's products, to maximize total client opportunity, not only for what they may be facing today, but what ultimately they might encounter over the course of a retirement journey that may last northward of 2 to 3 decades. And what we've seen from a developmental perspective over the last several years is an explosion in new stuff. So how do you sort through all the stuff out there? How do you make sense of what carriers are trying to deliver to you? And then how do you dive into those solutions that provide the best opportunity to maximize benefit for your clients over time? And so at Market Synergy, our challenge and our charge is really to deliver solutions, flexible solutions that are designed in today's marketplace with today's economic environment in mind to deliver maximum potential over time. And no matter what those client needs might be today, tomorrow, or well into the future, offering solutions that are flexible enough to make you be able to continue to work and meet their needs at and throughout retirement. So with today and where we're at in terms of a market cycle, in terms of a development cycle, it's absolutely essential to have safe accumulation opportunities available. Providing safety, eliminating risk, and delivering on that is key. And whether it is a key tenet of your business or not, looking at, evaluating, and offering the potential of sustainable income opportunities is critical as well for a number of reasons that we'll get into. And so if we can maximize safety during that accumulation phase, protection during the beginning of that decumulation phase, and sustainable income opportunities over time, then we're providing ultimate max client benefit for your customers. Now, challenge is there's lots of ways to do that. Companies choose to take different paths, design products in different ways. And what we've seen over the last several years is a real move towards, again, trying to fill a lot of needs and provide a lot of flexibility. And I think that's critical moving forward to be able to do that. And if you look at the key challenges that face us as planners and our clients as well, it's really right now, I would argue, number one, mitigating market risk. And we'll talk a little bit about why that is. And I'm sure many of you are well aware of why that is as we continue down maybe perhaps the latter stages of this record-breaking bull market run. And then balancing, not only mitigating risk for those that are at or approaching this transition into potentially the income phase of their retirement cycle, but balancing the opportunity to continue to accumulate while protecting from downward moves as they get to that point where they're ready to flip the switch. Also protection against dying too soon. We talk about oftentimes in our business longevity risk, and Jack just touched on it there, and dealing with longer lifespans, but also having the flexibility and the benefit to provide legacy protection and untimely death. And we think that's critical in some of the products that we work with today. And then finding solutions that are really flexible enough to meet changing needs, because life happens, things happen, and I know each and every one of you can probably think of many, many client conversations that you had when you introduced a plan, introduced a solution, and then the circumstances surrounding the execution of that plan dramatically change with life events, with things that happen, with things that unfold that no one can foresee. And so having the flexibility in product design is absolutely critical to deliver max benefit over time. And I think most importantly, leveraging recent innovation in our marketplace. And if you look at a lot of the top selling products in our space today, many of them have had a life cycle that's approaching 8, 9, even 10 years. And I would put it in this context. I mean, how many of you are driving the same car you were 5, 6, 7 years ago? How many of you are using the same telephone that you were using, 5 years ago? The point being, the annuity industry is no exception. Innovation and change and design improvement is ultimately a benefit to the customer. And as interest rates have improved, the pricing environment has improved. And I would say if you're still offering solutions that were maybe 5, 7, 10 years old, it might be time to look at something new, something innovative, something developed in today's marketplace that I guarantee will provide a max benefit opportunity, maybe in addition to what you're currently working with today. And all of this while eliminating or reducing fees that can critically undermine our planning opportunities as we approach retirement. So the first part of that was all about accumulation and doing that safely. And what we're looking at here is just S&P performance over the last 20 years. And I think what I want to point out, I guess, are two things. First of all, if you look at the right side of the screen and the big green line going upward, that represents the current bull market we've experienced from the financial crisis of '08, about this time in '08, as a starting point through the present. We've seen a great run. And as all of you are probably very well aware, our clients have a tendency to have very short memory. They don't remember this period. If we look at the left-hand side of the screen from basically 97 to 2008, where being invested in the quote-unquote market was a zero-sum game. There were ups, there were downs, there were opportunities, but if you were in it the whole time, you were basically flat over that 10-year period. Now, whether or not you think this bull market has more legs, or whether you think we're maybe at a place where it's maybe starting to contract a little bit, either way, I think we know this period of continued perpetual upward movement can't continue forever. And at some point, a correction will occur, and we need to have that protection. Now, for context, if you look at historically speaking, back to 1900 in our equity markets, if you look at the right, once every 3.6 years, oops, jumped ahead of here, let's scoot back. Once every 3.6 years, there's a major bear market event, meaning a 20% or more decline in the equity markets. Well, as you just saw, we're over 10 years into this run. Some could argue well overdue for that correction. So something to always remind our customers of. Certainly, any of us and every one of us can have compelling conversations about deleveraging, de-risking, accumulation portfolios, especially for those that are at the doorstep of retirement and potentially getting ready within a very short period to start thinking about income, because not only is sequence of returns ultimately the big killer when they start income, but it can be devastating as they approach and we get ready to flip that switch as well. They can't recover from 5, 7, 10% loss to portfolio right before they flip on the switch. But as you can see here, it's even more dramatic of an impact once they turn on that switch. The return in the first year of retirement explains more than 14% of the final outcome for retirees. So having solutions, safe solutions that eliminate those downward moves are absolutely the critical bedrock for any planning for those approaching entering retirement. So this is looking at the S&P for the last 10 years or so, and it's been a good ride, up about 60%. But even during this kind of perpetual stage of increase, there's pitfalls for those that are right at that starting point for retirement or that ending point of accumulation. This is just looking at April 2015 to April 2017, and all the red arrows represent a major or a significant correction of 5% or more just during this short period of time. So if clients are unfortunate enough to be in the market unprotected and starting income or getting ready to start income at one of these points in time, they are forever impacted in a negative way that they can't recover from. Again, pointing to this very clear picture and very clear need for safe accumulation opportunities. And so that brings us to a little bit of a comparison piece, and we'll kind of touch on each of the factors I talked about, and then look at some of the products in the industry and how they're attempting to meet this need. So from a safe accumulation perspective, safety plus upside potential is the key that these all deliver, and all FIAs are going to offer this protection. That's the beauty of the industry as a whole. Any product that you sell that you're comfortable with, they're going to protect downside, and that's the number one objective here. But then the flip side of that is, how do we provide that protection and do it in a way that offers a compelling enough upside for our customers to, pay for that protection, so to speak. So we understand it's going to be, the upside's got to be limited if we're eliminating the downside. So how do we create compelling opportunity for that? Well, in a record low interest rate environment over the last decade or so, the way that we did it as an industry was rolling out volatility controlled index options and hybrid index options. They're wonderful things. They can work remarkably well. We have a number of them with the product partners we have. And you can see here, this is showing many of the top products in the industry today, many that we compete with, some that we've designed, and the strategy they're using, then the illustrated, most recent illustrated rate that you would see on an illustration if you ran one today, and then the accumulation, hypothetically, generated to year 10 of a policy. So as you can see, it's all over the board. We have the product that we just rolled out is called the Lincoln Retirement Safeguard. We've got some multiple opportunities and strategies with it here. What I want to point out is that not all FIAs are created equal. And the beauty of these hybrid indices is they offer upside in a low interest rate environment by controlling volatility, but they bring the complexity of explaining something beyond just the market as a driver for performance. And as we've been able to get improvements in rates and improvements in pricing, the simplicity of a single index design like the S&P 500 with a simple crediting methodology like a par rate really improves in our mind the ease of client conversation to help them understand exactly how the methodology behind them earning interest credits takes place. And it may or may not be the strategy that delivers the most in any given year, but I believe that by aligning yourself with a simple single index solution like an S&P par rate with an attractive par rate percentage, when the strategy you recommend doesn't deliver, you don't become the scapegoat and have to explain, well, why didn't the PIMCO Global Optima Index deliver the 8.66% return that you showed me on an illustration? And then you have to go through the monthly rebalancing and the weighting that takes place and any other methodology that occurs and the momentum signals that it uses. If you have to do that, you've lost. That's a challenge. You're moving backwards and you're on your heels. With a single index, simple par rate strategy, offering it to client as, hey, the way this works, if the market performs, we get half of it. If it doesn't, we're protected. I don't know if the market's going to go up. I don't know if it's going to go down. This offers us the ability to be able to take advantage of when it does go up, but be protected when it doesn't. When the market goes down, they're not calling you trying to understand how the S&P works. They know the market went down. And you're a hero because all of their friends lost money with their equity-based investments. You provided the down floor of zero protection, and they love you for it. So something to think about as we move forward. Not a knock on hybrid strategies. We believe in them. We think they're great. But for a move back to simplicity, a move back to simple explanations, we think single index is a great, great way to go. Plus the ability to have them locked in every year rather than a 2, 3, or longer reset period, which many hybrid indices employ. Lots of options here for accumulation. You can see the numbers are all over the board. What I want you to notice is with the new Lincoln Retirement Safeguard product, we're able to deliver leading accumulation to the 10-year. It's a 10-year product, but then also an enhanced death benefit opportunity that far exceeds any of the competitors in the space. So some may show a little higher accumulation. Again, these are hypothetical numbers, but having the ability to say, we can give you compelling, simple, upside accumulation potential paired with a significant legacy benefit to your heirs in the event of your untimely death during this accumulation period. So we like to say and think that in this new era of innovation, if you don't have some kind of legacy death benefit, enhanced death benefit protection on your safe accumulation, you're not maximizing the total benefit of your client's policy. So moving on, I'll make one last pitch for S&P par rates and the simplicity of it and the beauty of it. This is looking back over the last 20 years. On the left is the S&P 500 price index only. If you look at the average return, annually speaking, over that 20-year period is 5.2%. By using an S&P 500 par rate, 50% and eliminating and turning all the zeros that are actually experienced in the market to the zeros, you're getting 5.4% annual return over that same time frame, and actually outpacing accumulation over that period. And this is just graphically showing hypothetical growth of $100,000, S&P par rate 50% over that time frame, actually over $12,000 better from an accumulation perspective because of simply eliminating those downward moves in an easy to explain, easy to understand strategy.
Ted, quick question. So is this based on an annual reset kind of an approach?
It is an annual reset, absolutely. Now, many of the strategies that we looked at on the chart range anywhere from annual resets to 2 and 3 year resets.
Perfect. That was the question.
Thank you. The S&P par rate strategy is a simple annual reset alternative. Yep. So where the most of the business in our space is being transacted is absolutely what we just discussed. Safe accumulation, whether you're trying to get people to the doorstep of retirement, whether you're looking for bond alternatives in a managed money environment, FIAs deliver with that principal protection, upside opportunity. All will do that. Not all will do it equally. Maximizing benefit in terms of death benefit, optional death benefit enhancement is critical. Now, you may say, hey, that's what I do. I don't do income. But I think the key to recognize, and if we go back a few slides and we looked at the graph of the recent bull market run, but during that 20-year time span, and from 97 to 2008, that full time frame of a zero-sum game. And we may or may not be at the end of the bull market. We may or may not experience something like we did from 97 to 2008, where it's a zero-sum game. But if we do, and performance isn't there, no matter what product alternative we choose, having a backstop of free enhanced retirement income opportunity is critical. Again, if you don't have to pay for it, if you don't have to have an experienced fee erosion to generate it, why not have the opportunity at the end of the 10-year period or policy period, be able to see, does it make more sense for me? Can I meet my client's needs in a better way by moving this to the new latest and greatest because I'm out of surrender, or leveraging an enhanced income benefit option that may be significantly outpacing what the current market can bear? So having income opportunity is essential, we feel, to maximizing that total client benefit. And we know longevity issue, people are living longer than ever. These statistics certainly aren't new. And it's compounded by the fact that costs aren't going down. In fact, they're going up very rapidly. You know, these numbers are a bit dated. This is from a few years ago. But a 65-year-old couple retiring in 2016 would take about $250,000 to cover just their medical expenses throughout retirement. If you look at the right, this is showing a modest average rate of inflation. What a customer would spend to cover $60,000 worth of retirement expenses today is going to cost more than double that 30 years into the future. So not only do we need to provide strong income, we need to maybe provide opportunity for that income to grow over time. So having that flexibility to meet either level or increasing income on a leading basis is critical. We built that into the product solution. So we'll look at just some comparisons here of where some of the leading level income generating competitors are. Again, the LFG is our new Lincoln product. Initial income is income at year 10 for a 60-year-old, so that's 70. The guaranteed income, because these are performance-based products, is the worst case. What they get if there was no market performance, no index credits over time to drive growth. And then cumulative income to age 85 versus guaranteed income to age 85. So as you can see, the LFG product with our multiple strategy options is delivering leading initial income with the strongest guarantees. A nice combination. If you want to look at it graphically, we can take a look. This is just showing how that bears out not only at initial income level, but then over time, again, maximizing that cumulative benefit to the client throughout retirement. Now, if they are concerned about increasing income, showing the same thing. There's a few different players in this space because different products do different things. This brings in a number of the prime path, the agility, the 222, and a lot of their crediting strategies. You can see where initial income is generated, what guaranteed income levels are, and then again, that cumulative income to age 85 versus guaranteed income. We're not always going to be the highest, but we're always going to offer the best combination of potential, guarantee, and growth opportunity. So again, here, graphically looking, what we just saw, Lincoln's delivering leading initial income, and then at the top tier for cumulative income. And we'll take a closer look at how this kind of breaks down with the players in this space. This is really where we see some of the best innovation taking place today is in this subset of products with our new retirement safeguard from Lincoln, the agility from Athene, the prime path from North American, and then the 222 from Allianz, which has been around for quite some time now, been the leading product in the industry. So looking at these products in particular, because they all are do similar things. They're offering death benefits, they're offering accumulation potential, and they're offering substantial opportunity for increasing income over time. There'll be different nuances with all these products. And I'd argue you can't go wrong with the design of many of these. We love the product designs of all these products. I think the 222 was the trailblazer. We copied a lot of their stuff and made changes that we wanted to see, that we'd experienced producers and clients wanting to see over time. And that's the benefit of having the ability to look at a product and then make changes as it comes out. So you can see here the top chart showing the product with accumulation versus death benefit. We already saw this previously, but I'm going to point out is for no fee, the safeguard with an S&P par rate is leading the accumulation game and leading the death benefit game. So whether you're not concerned with income, have other opportunities, other assets set aside for income, this is strictly an accumulation play. We're going to deliver on the highest level, but then most importantly, have the biggest backstop to provide legacy protection in an untimely death. Look at the bottom. Now we're looking at income. Okay, so what if something happens? We do need to rely on the income generating part of this. You can see agility with the Janus market consensus index generates more cumulative income to life expectancy, it's roughly 85, than our products do. But what I would say is, Janus it's a new index, did very well last year. I think if you believe that that's going to continue at that pace, those numbers are sustainable. If not, the thing that concerns us with that product is the low S&P par rate cap. That's the alternative. And so instead of leading the pack at nearly $380,000 of cumulative income, you're really taking a step back for that S&P cap rate. So just food for thought, and the ability to mix, I think, is critical. With an S&P par rate, we can lead the initial income amount. We can provide ultra competitive cumulative income to age 85. And we think, again, we're biased, but we think creating the best combination of benefits in this space for your clients, no matter what their changing needs may be. And so what I'll do now is kind of walk through a little bit of the product specifics, how we do it. So we've shown you numbers. How's it done? I promise this will be very brief. The beauty of this is that the experts at InsureMark know these products inside and out. And so we can go through the highlights, see if it's a fit for your business, and then I would encourage you to reach out to your marketing partners at InsureMark to get all the details, all the specifics, and see if we can partner on business together. But again, the design philosophy is really to be and utilize one source of client assets for 4 distinct uses. And the number one use, accumulation potential. Secondly, enhanced death benefits. Third, lifetime income opportunities if necessary. And then fourth, confinement benefits. So enhancing that income generating potential should they become confined at any point during the process. And we do that with a partner that we're extremely excited about to be working with. Lincoln Financial is a very large U.S.-based insurance company. They do only U.S. insurance-based business and have been doing so for 113 years. A+ rated with Best. You can see all the ratings there. They have not been a major player in the independent producer space up to about the last year or so. They're making aggressive moves, and we're extremely privileged to be an exclusive partner for distributing their product through our partners. And so this is a great opportunity that you can't get everywhere. This is only through our Market Synergy Group network. As I mentioned, InsureMark is one of our founding members and core partners. So what's the product and how's the product built? We use 3 different indexing opportunities to provide potential for upside growth. We're excited about the new Ascenda index from BlackRock, the leading money manager in the world. We do things a little uniquely. It's a 2-year reset. It's kind of a balanced portfolio option, and it uses what we call an interest credit bonus, which is currently 1%. So anytime over the 2 years there's a positive credit in that strategy, the client gets an additional 1% tacked on their income credit for that year. So something different, something unique, and be sure to ask your marketer about how that works. We have an S&P daily risk control option, as well as the S&P 500 par rate. We have a par and a cap rate, but the par rate is attractive right now. Design of the product is 10 years in duration, 9% surrender charge and down. We allow 10% free withdrawals starting in year 2. Nursing home and terminal illness, during that deferral period, income's available at and after the 10th year of the policy. So how do we lead income? We provide a free guaranteed lifetime withdrawal benefit, standard on the policy, there's no charge, and immediately at issue, the client receives a 15% income-based bonus to that amount. So they put in $100,000, it's $115,000 of income generating potential immediately. Then every year, no matter what strategy they choose, any growth that occurs there is enhanced by a multiplier of 150%. So 5% interest credit in a year becomes 7.5 to building that income base. Then at the end of 10 years, if growth hasn't been sufficient to take their initial amount over 150% total growth, we'll guarantee that their income generating amount will be 150% of their original premium at that point in time. So again, to use the example of $100,000, if at the end of 10 years there hasn't been enough growth in the credits to take that account value or that income-based value beyond $150,000, we'll step it up and make that minimum income base $150,000. The death benefit, certainly a very important part of this. The way that it works is available after the first year. It tracks the income base. So it gets the same base bonus of 15%, the same multiplier of 150%, and the same checkpoint of 150% at the end of the 10th year. Now, it's important to note, this death benefit will grow to age 70 and stop. So a 60-year-old will have 10 years of income benefit roll-up, or a death benefit roll-up, excuse me. A 55-year-old will have 15. A 65-year-old will have 5. It doesn't go away, it just stops. When they take income, it draws down that death benefit on a pro rata basis, but it doesn't go away. So again, creating that lasting death benefit opportunity at no charge to protect and provide legacy benefit payable over 5 years. Competitive income factors, both for level or increasing. There's a 50% reduction for single to joint in either case. Ultimately resulting in a product solution that we believe checks all the boxes for you as a busy advisor, planner, confidant to clients that are trying to navigate the retirement journey, trying to sort through all the new stuff, new products, new strategies, new solutions that are thrown at you every day from every angle. We know that we need to deliver these benefits and do it at an industry-leading level in order for you to give consideration to our product, to learn it, to get comfortable with it, and to share it and offer it as a solution to meet your clients' needs, not only today, but most importantly, tomorrow and on down the line as events happen, as life changes. Strong carrier partner in Lincoln Financial. We couldn't get any stronger. Safe accumulation opportunity. Again, the par rate is very attractive. We love the BlackRock story, and the S&P vol control strategy is kind of a safe, steady opportunity throughout time. Free benefits. They're generating that income backstop if they decide to do that or growth isn't there. Death benefit for legacy protection. With this product, we didn't discuss it today, but you can actually enhance your death benefit further and your income opportunity further by buying a rider. You can buy a rider for 1% that increases that opportunity to 175% multiplier on both the death benefit and the income story. And then competitive compensation, 7% street comp for you, recognizing the challenge, the difficulty, the critical function you serve in today's marketplace for helping people approach and navigate through retirement. And so why this design, one last time, is if they don't have a plan, they don't know when exactly they're going to retire, if they don't know how much they're going to need, if they're worried about providing increasing income, it's flexible enough to fit, to fill, and to serve any of those needs. If they don't have a specific income need, the no-fee version that we covered today is the way to go. There's no fee drag for great accumulation. The enhanced death benefit is there if they pass. But if they do decide they want income, they need income, you're doing some specific laddering or planning, you can buy up the rider, enhance that income opportunity, and then maximize potential income in that manner. One bucket of money, multiple uses, and again, broad utility of one product to simplify your life, to simplify your solution product, and know that what we talk about today with the Lincoln Retirement Safeguard will meet not only the what's that they're facing, that they're talking to you about today, but the what if that are invariably going to arrive over the course of a 10-year policy lifetime or a 30 to 40-year retirement cycle. That's a brief introduction, brief setup, and a brief thought process behind our positioning, the competitive landscape, and how we fit. And I really appreciate the time to share that with you today. And with that, one last thing I would encourage you, if anything, if you have questions on any of this, please consult with the experts at InsureMark. And also, they know how to get a hold of me if you'd like to conduct some further conversations about any of this. I'd love to share my thoughts on that as well. But again, thank you for your time. Thank you for, hopefully, the opportunity to partner with business going forward. And with that, I'll turn it back over to you, Jack.
Thanks, Ted. Great job. So we're going to wrap this up right now. Just to tie this back, you remember Ken and Maddie Dykewald told us that there's this new flex retirement concept. And those people, that 10,000 people a day who are retiring, when you ask them what's their biggest thing they miss, and the answer is reliable income. And I think Ted did a great job of showing you how you can provide that and still address their cyclical retirement needs. So at InsureMark, we're committed to making sure your life's work gets more client time, more family time, and more value. And we do that through a process of driving business alpha. Each of our advisor development consultants is prepared to help you build a plan so that you can attack and gain a larger share of this attractive market. We do that through a process called value engineering, and at the end of the day, they become an asset to you. They're able to take some of the load off of you in terms of building your business, but more importantly, they're able to help you get clarity about how to grow your business. We've got a couple of events coming up. There will be a new podcast with Coach Joe Lukacs that will be released early next week. And then on November 13th, We have Tom Hegna, economist, author, and keynote speaker, who's going to talk to us about the psychonomics of retirement. So another way to to realize greater share of this expanding retirement planning market space. So we want to thank you all for joining us today. Please feel free to give us a call at 800-752-0207. We'll be happy to answer any of your questions about the Lincoln product, about Business Alpha, value engineering, or any of our upcoming events. Thanks and have a great day.